All right. Today is Tuesday, August 17th. This is a recap for the stock market activities. Today, I got a good one for you. Before we do that, what the is this? This is the chart of the S&P 500, ladies and gentlemen. This is the market, the stock market. And it has turned into a joke, a meme, not a real chart. This is what the Fed calls market functioning. Yesterday, we got ahead of Coke, bouncing higher, closing at the highs of the day. Today, we suffer a withdrawal and the market opens gapping down. But the relentless market manipulation efforts will not stop at all. They have used every method available in the last 2 days to manipulate the market and prop it up higher. Rescue operation after rescue operation after rescue operation. Don't panic, folks. We're just going to taper. No biggie. The market is not going to go down. No need to panic. And we're going to try to manipulate the market, propping it higher, buying every dip for you to lure you morons so you can buy the dip. And hopefully we can succeed in giving you the illusion that tapering and ending the cocaine operation, the so-called accommodative policy of the Federal Reserve that has been going on for over a decade now. That's not a big deal. The market has real legs to stand on. You know, like valuations and corporate earnings. That kind of stuff. No need to panic here, folks. If there is no need to panic, then there is no need to manipulate the market every single day. We will see the dip. If we feel that the dip is worthy of buying, then we'll buy it. That's how the free market works. Not in this propaganda machine world that we're living in. They have to give you the illusion, the false narrative, that the appetite for dip buying is alive. But today, we found out that the so-called appetite for dip buying was nothing but a charade, a phony action on the charts led by market manipulation, where the Fed and their dogs, the hedgies and the likes, manipulate the market, pumps and dumps all over the place, taking advantage of us retail traders and investors, our naive, moronic stupidity. Let's see if the rescue operation today, they tried hard, really hard, every single method available, but this time it feels a little different. As if people are not buying this one. We're not going to be fooled this time around. Some of us will, the morons, you know, the Robin Hoodites and the likes. Those people were born to be slaughtered anyways. But the majority of us, retail investors who've been investing in the market for, let's say, more than a year, we're not going to fall into this trap. At least for now. We'll see what happens. But in focus tonight, let's talk about the slew of macroeconomics news we got today and the impact of that slew of information on inflation. There is a massive debate going on. Is it going to be deflation, inflation, stagflation? We will go through the facts and I will let you know where I stand. And then we're going to talk about the possibility of an invasion of Taiwan, a surprise attack, a surprise takeover overnight by China. What will the response be from the United States? Spoiler alert, nothing, specifically after what happened in Afghanistan. But most importantly, what will the market reaction be? Let's start with the macro story. We got retail sales, and it was a massive miss. And of course, the media, economists, analysts, YouTube personalities, they're all taking this data and going on with the narrative, whatever narrative they've been pushing for. Let's hear what the media is saying about this number, and then I will go over the facts, the true numbers, and I will tell you what I think. Let's start with this one. Americans spent less at retail stores in July, reflecting a shift towards services such as travel and entertainment. People also took advantage of fewer COVID restrictions to dine out, go to a ball game, or take long, delayed trips away from home. Here's from Bloomberg. Drop in U.S. retail sales indicates shift to services spending. So again, you might have heard the narrative, retail sales cratered, dropping off the sky, it's over. The impact of the cocaine in the economy is gone. We're gonna go to deflation, recession, yada, yada, yada. But according to this, at least this one, it says that we have some behavioral shift in consumer spending. So keep that in mind. Here is the headline reading. Of course, the headline number was down. We have a slowdown in consumer spending activities. Now, heading into this number, in the back of our heads, we were worried about the Consumer Sentiment Index out of the University of Michigan, which was an absolute disaster. So does this report, the retail sales report, support the Michigan data, which is preliminary, by the way, a little bit. I see some support, but not a lot. Let's continue. Reuters says automobile shortages weigh on U.S. retail sales. Pay attention now. Automobile shortages. Keyword shortages. When we talk about the quote-unquote collapsing consumer sentiment and consumer spending, is it happening because consumers don't have money anymore? Or consumers lost jobs and they don't have disposable income? Or is it happening because consumers are facing shortages and extremely high prices? And they are finally waking up from the zombified state and they're saying perhaps it is not a good time to buy here. In addition, we've already hoarded a lot of goods, clothes, electronics, furniture, garbage. Things we need, but mostly things we don't need. All of that happened last year, so keep that in mind. This is from Reuters. Sales increased 15.8% compared to July last year. Receipts at auto dealerships, they're talking about the auto sector of the market, fell 3.9% after declining 2.2% in June. Motor vehicle production has been hampered by a global shortage of semiconductors. The scarcity of chips has also impacted the availability of some household appliances like microwaves and fridges. Pay attention now. Even as demand remains strong, remember, inflation has demand and supply. Two different dynamics. Demand pull inflation and supply push inflation. We have both this time around. Pay attention. Motor vehicle sales have continued to fall over the past few months as the semiconductor shortages have made it difficult for consumers to find vehicles they want regardless of the price, said Sam Bullard, a senior economist at Wells Fargo in Charlotte. Retail sales are mostly goods, with services such as healthcare, education, travel, and hotel accommodation making up the remaining portion of consumer spending. Restaurants and bars are the only services category in the retail sales report. Sales at clothing stores fell 2.6%. A rebound is expected as parents shop for the new school year. Online retail sales dropped 3.1%. Again, was this expected or unexpected? It was 1,000,000% expected. We're not shopping at Amazon anymore. We're shopping outside. And we've already hoarded everything we need and everything we don't need. Sales at building material stores decreased 1.2%, and therefore you saw the reaction in Home Depot and Lowe's stocks collapsing today, crashing. Receipts at sporting goods stores, hobby, musical, and bookstores declined 1.9%. But consumers increased spending at restaurants and bars, leading to a 1.7% rise in receipts. So this is the shift from goods to services. Sales at restaurants and bars increased 38.4% compared to July 2020. Again, is this a surprise or not a surprise? It's not a surprise. Last year we had a shutdown. Now we have reopened and people are going back to bars, restaurants, etc. Sales at electronics and appliances stores gained 0.3%. This is from the Wall Street Journal now. Retail sales rose briskly earlier in the summer as shoppers boosted spending on services such as dining out and traveling and away from goods. That shift occurred as more Americans became vaccinated and state and local governments eliminated many COVID-19 related restrictions, some of which have now been reimposed with the recent rise in coronavirus cases. Pooja, whatever your name is, I don't want to butcher it out of respect. U.S. economist at Barclays said she expects increased services spending to continue, but that consumer spending will grow more slowly than earlier this year as the boost from federal aid to household wanes, aka stimmies and cocaine. U.S. consumer spending rose at a robust 11.8% annual rate in the second quarter, contributing strongly to the economic growth during the period. Meanwhile, retail sales overall continue to clock in well above monthly pre-pandemic levels. So if you hear on YouTube somebody saying retail sales crashes, the economy is doomed, Ironically, of course, because you might have noticed the title of this video. Not true, at least not for now, because we are registering numbers higher than the pre-pandemic highs. So retail sales remain strong, but they are slowing down significantly. We'll go over the numbers in a minute. Sales in July were about $91.9 billion, or 17.5% higher than in February 2020, just before the pandemic's onset in the United States. Supply chains constraints, underline supply chain constraints, have limited sales for some industries struggling to get necessary materials. Separate data released Tuesday by the Federal Reserve suggested those constraints may have eased some in July as U.S. industrial production, a measure of factory, mining, and utility output, rose as seasonally adjusted 0.9% during the month compared with June. We'll talk about industrial production in a minute. But here are the facts regarding retail sales. Let's go over the different categories and look at the number year over year. Now, in categories like non-store retailers, aka Amazon, year over year, we're down 3.5%. This is expected, folks. We're not going to spend and shop at Amazon forever. We're going to go out, and therefore you're seeing food services and drinking places. The spending is up 1.7% year over year. Likewise, miscellaneous store retailers up 3.5% year over year. Gasoline stations up 2.4% year over year. This means that we're shifting from one behavioral spending to another. The bulk of the declines came from auto vehicles and parts dealers, down 3.9%. Now let's move a little here to the last columns. Let's look at the first quarter of the year and the second quarter, almost the second quarter, because we start counting from February. Are we seeing significant slowdown or growth in retail sales? Well, here are the facts. When we look at building material and gardening, etc., this is down 5% from the first quarter to this second quarter, which ended in July, according to this report. Down 5%. We have some weakness in furniture, small weakness, and in non-store retailers, aka Amazon. But every other category is still growing, whether we're talking about electronics, whether we're talking about gasoline stations, clothing, food and services, up 14.7%. But perhaps the most important parameter and ratio we should look at is the month-over-month growth or lack thereof, because we want to spot the slowdown before it happens. We're looking for leading indicators here. So here it is. I hope you can see this. If not, you can pause and zoom in. Out of 14 categories in retail spending, month over month, from June to July, 7 categories were up, so spending was positive, increased in 7 categories. Meanwhile, spending decreased in 3 categories. These are the motor vehicle and parts dealers, the building material and garden, aka Home Depot and Lowe's, and then we have the non-store retailers, aka Amazon. Other than that, every single category was either up or flat month over month. Again, is this an indicator of anything beside that the economy is still hot and the impact of the Coke and the stimmies is still here? It is still circulating within the economy, and the circulation of stimmies and cocaine in the economy will result in inflation. It already resulted in inflation. Folks, we're not talking about predictions here. We're talking about facts on the ground. Somebody says, deflation, disinflation is here. What are you talking about? What kind of stuff are you smoking? We have the hottest inflation numbers in decades. And they're not going to stop anytime soon, even facing Delta and many other restraints. This is factory production now. Production at U.S. factories strengthened in July by the most in 4 months, lifted by autos. So the sales are down because lack of availability. But as we speak right now, they're manufacturing autos as much as they can, because remember, we have the chip shortage. This is something that our auto manufacturers cannot control. We don't have any chip manufacturing in this country, at least to the scale needed to address the shortage. Industrial production stronger in July, up 0.9% versus 0.5%. That was the estimate. Notable rebound in auto production. This is up 11.2% despite ongoing supply constraints and longer lead times. So once again, industrial production, inflationary or disinflationary? The answer is inflationary. Okay. How about home builders' confidence? U.S. home builder sentiment fell to a 13-month low in August. Why? Is it because interest rates went higher? Is it because the consumer ran out of cash? They're not borrowing anymore? The consumer is borrowing once again. They're sliding those credit cards up and down, up and down, up and down, racking in more debt than ever in terms of the pace of increase. Is the home builder sentiment down because the consumer lost their jobs and now they have to downgrade, not look forward to buying a house? Or is it due to inflation? Here it is. High costs, supply shortages continue to beleaguer home builders in the U.S. It is the costs for home builders and the insane prices for the consumers, causing home builder confidence to collapse, along with the home buyers' sentiment. When we talk about the consumer sentiment in the University of Michigan, what does that say, by the way? Is this deflation? Is this disinflation? Is this recession? Or is it stagflation? When the prices go too high, slowing down the pace of economic activities and reducing the confidence. Of course, the assumption is when we talk about the supply and demand dynamic, if inflation goes too high, causing stagflation, therefore prompting the consumer to change their sentiment and attitudes and spending, therefore reducing the demand, the expectations are that prices will go down. And therefore you have deflation, disinflation. But what if prices continue to linger higher due to supply constraints? Things we cannot control, things like the shortages, the port closures in China, the wildfires, the drought all over the planet, the extreme weather in the southern hemisphere, in addition to the money supply that is not stopping right now. So the aggregate demand is still here. This is classic stagflation. Now, let's read some inflation data from overseas, specifically the United Kingdom. 1 million vaccines and soaring wages fuel UK inflation fears. Job vacancies in the United Kingdom hit a record high last month, and wages soared by 7.4% between April and June, adding to fears of a prolonged period of rising prices as companies pass on higher costs to consumers. The strong recovery in the labor market was highlighted in data published Tuesday by the Office of National Statistics. This is the English kitchen. Ours called the BLS, the Bureau of Labor Statistics. They have the Office for National Statistics. And it could further fuel inflationary pressures in the UK economy that could prompt the central bank to hike interest rates as early as May 2022, according to some economists. Okay, so we have new subscribers in this channel. Thousands that we have gained in the last few weeks. They have no clue where I stand on the inflation debate. Here it is. We have the camp of deflation, saying that inflation will be transitory. And the reason is not because the bullshit reason of the Fed, by the way. The Fed says it's going to be transitory, but prices will not go down, by the way. Oh, and the economy is just going to be fine. This camp, the deflation camp, presented by Rosenberg, who is one of my favorite economists, and I respect the guy, he just has a different point of view. They believe that the economy is in a zombified state, fueled by stimmies and cocaine. And once that impact is lifted, we will go back to deflation and perhaps a recession, because the economy has no legs to stand on, and inflation will just shut down. Then there is another camp from another economist that I respect, represented by this economist, Mohamed El-Arian, among many others, who say that inflation will prolong and persist a little longer than the Fed has anticipated. And then you have the extra spicy camp, who says not only we're going to have inflation, but we're going to end up having stagflation, meaning the pace of economic recovery goes down, economic growth goes down, but prices will linger higher, meaning combining the mild and medium narrative regarding inflation. Yes, the economy will slow down because it is a zombified economy, but prices will linger higher due to the power of the money supply. This was a historic spike in money supply. You're not going to wash that out quickly. In addition, we have other phenomena: shortages, COVID-19, shutting of ports, the unequal recovery globally. You have economies wide open, other economies completely shut down. We have the weather phenomenon. All of that will contribute to a stagflation force that is inescapable, by the way. The deflation camp talks about technology, Amazon, China as the driving forces that will pull back inflation. When you think about it, Amazon ceased to be a deflationary force. They have a monopoly now. They don't have to compete in price anymore. And they're actually raising wages and therefore prompting the entire industry to raise wages. Therefore, Amazon changes from a deflationary force to an inflationary one. Likewise, when we talk about China, it used to be a deflationary force, but now wages are rising in China, and we have shortages, closure of ports, and now China is becoming an inflation force. Likewise, when we talk about technology, efficiency is deflationary in nature. However, technology also enabled the younger generation to have other options. They're making money trading stocks at Robinhood. They're making money making videos on TikTok. They're making money making videos and selling pictures of their feet on OnlyFans. In addition, we talk about the demographics. You know, the deflationary camp says demographics. Oh, the demographics. Oh, that's the one. The demographics. Here's the truth. We have the greatest transfer of wealth in history from the boomers to the millennial generation. Now you're going to have the millennial generation with an increased purchasing power. All of a sudden, out of the blue. They inherited the money, and we have lots of estate planning that took place this year and last year as the COVID-19 crisis hit the economy. So the money's being passed from one generation to the other. The other generation, the millennials and the Zers, what do you think they're going to do with the money? They're going to go out and spend it. And therefore, the demand side of the supply and demand dynamic is still healthy and growing higher and higher and higher. Meanwhile, technology, remember technology, the deflationary force? Well, technology is now becoming inflationary. And the reason is all of that spending from new wealth in the economy will not result in creating jobs and growing the economy in the traditional methods been used to, as more and more of these jobs will be transferred from human beings to robots. Now, what do you think the government will do with the large number of unemployed people due to that transition from human beings to robots, specifically in the low end of the employment spectrum? We're talking about the McDonald's employees. We're talking about the check-in employee at the hotel. All of these jobs will be replaced, but the government will have to keep those unemployment benefits forever and ever and ever. And therefore, we're going to have a significant slice of the population sitting at home, collecting government checks and spending in the economy. We have a seismic shift here that will leave us in a stagflation phenomena, the likes that we have not seen since the 1970s. This is at least my take. Therefore, I am with the Rubinis of the world. Speaking of Rubini, stop it with the deflation talk and the transitory talk and all that crap, and join the real party, the doom and gloom party. You see, Professor Rubini has a reputation of being a party animal and a ladies' man. Rumor has it that Professor Rubini, in his famous hot tub on the top of his penthouse in New York City, he tells the young ladies a story that he is not worried at all about deflation. Deflation is not a problem that Professor Rubini even worries about. What concerns Professor Rubini is hyperinflation, specifically in the sensitive areas of the the economy. Hyperinflation is what keeps Professor Rubini up at night. So do you want to join Jerome Powell or these deflation people? Boring. Or do you want to join the real action, the doom and gloom party, courtesy of Professor Rubini? It's an easy choice. You know, when stagflation happens, drinks prices are going to go higher. They're going to skyrocket. Meanwhile, you're not going to have any money to pay for those drinks. But if you join the doom and gloom party with Professor Rubini and I, then drinks are gonna be in the house. But you better make that choice right now before it's too late. Lastly, before we proceed to the market coverage, let's talk about the wall of worry once again. Revisit the wall of worry. And this time around, we're adding Taiwan in the wall of worry. After the disastrous pullout from Afghanistan, the world is watching, including China. And China is not only eyeing the $3 trillion lithium reserves in Afghanistan for their EV manufacturers, but they're also weighing in a possible invasion of Taiwan, a takeover, a swift takeover that will only take one night to complete. What do you think the reaction out of the White House would be? Mr. President Biden, time to wake up. China has invaded and took over Taiwan. You think President Biden will even remember what Taiwan is? This is from the Global Times, the propaganda mouthpiece for the CCP. Afghan abandonment, a lesson for Taiwan's DPP. The Global Time editorial. You see a picture of the Taiwanese Prime Minister being pushed into a hole by the American Eagle. Here's another piece from the Global Times. Taliban rapid victory embarrasses U.S., smashes image and arrogance. And here's what's happening right now as we speak. China shows military might and exercises off Taiwan in response to quote-unquote provocations. But here's the true story. They're not just doing military exercises close to Taiwan. China holds assault drills near Taiwan after quote-unquote provocations. Let me ask you a question. If we wake up tomorrow, for example, to the headline, China invaded and took over Taiwan, it's over, it's done. What do you think the response out of the United States will be? The answer is nothing. And Chairman Xi knows that exactly. If he successfully invades Taiwan in a day, one night, the United States will do nothing. Nothing at all. What are we going to do? Go to war with China over Taiwan? It's not like they invaded Florida. I mean, if they invaded and took over Florida, we might actually thank them for that. What else? Issue a statement of condemnation? How about tariffs? How about economic sanctions? Chairman Xi is laughing his ass off right now, but the ramifications on the global economy and the stock market will be extreme. We will see crashes like you have never seen before. And again, what are we going to do? Pull our companies out of China? Remember, the government is owned by the companies, the corporations. They make their money, the bulk of their money, from China. If anything, they'll support Chinese invasion of Taiwan. And with that, ladies and gentlemen, let's move on to cover the market's performance today. And here we go. The Dow Industrial Average closing in the red, down 282.12 points, or a decline of 0.79%. The Nasdaq down 137.58 points, or a decline of 0.93%. The S&P 500 closing in the red, down 31.63 points, or a decline of 0.71%. What about the sector's performance today? Leading the pack at number one and capturing the gold, the silver, and the bronze. Healthcare. The rest, shame on you guys. Shame on you. Every single sector of the market, with the exception of healthcare, managed to close in the red, led by consumer cyclicals, materials, and industrials. We talked about healthcare being the safe haven, the neutral side in the inflation-deflation argument, and perhaps holds some value when we talk about health insurers and the big pharma drug manufacturers. Other than that, there is no value left in the market at all. Perhaps this is the most important part, the market internals. Yesterday, looking at the charts, the market rebounded higher, closed at the highs of the day, which was a bull trap. And a lot of people fell into the bull trap. But the signs were there that this is a bull trap. Not a confirmation, but the signs were there. Number one, the pop was happening due to manipulation in the options market via Apple options. Number two, the market internals, the advance to decline ratio, were absolutely horrendous yesterday, regardless of what the charts look like. Number three, the VIX chart was indicating that the pop is not over yet. Matter of fact, it is just starting, and we will go over the chart of the VIX in the technical analysis part of this video. But for now, we saw a sizable rebound off the lows today. But was the rebound merited by the market's internals? Of course not. The NYSE 25% advancing versus 72% declining. The Nasdaq 30% advancing versus 67% declining. Awful. Moving on to futures. Everything is down. Crude oil down. Coffee down. Lumber down. Gold down. Silver down. Platinum, palladium, copper, lean hogs, wheat, corn. Everything is down, with few exceptions in OJ, cotton, cocoa, and canola futures. But pay attention to the currency market, by the way, because the Kiwis were down big today. the New Zealand Kiwis. Massive decline, over 1.5% decline for the Kiwis. Why is that? Because New Zealand has one case of coronavirus. And of course, they have the no tolerance policy, so they're shutting down the country. Full lockdown over one case, and this has impacted the Kiwis down and the US dollar higher. Moving on to the big casino, the options market. What's going on here? Number one, per usual, as expected, the key to market manipulation, Apple, with about 1.5 million contracts, about 75% of those were calls. At number two, significant uptick in the implied volatility and the options activities for this name, Pfizer, with about 800,000 contracts traded today, about 81% of those were calls. Tesla, number three, with about 650,000 contracts, about 61% of those were calls. What about the unusual activities that took place in the options market today? Starting with the ticker M for Macy's. Retail sales were down, but spending and clothing is still okay, and we have the upcoming back-to-school season, so they're buying the 21 calls for Macy's with the expiration date of August 27th, with expectations that the name will rise by over 15% by then. They paid about 30 cents apiece to enter this trade. All in all, spending about $570,000. What about the trade for the ticker F for Ford? They're making a bearish bet here by buying the 11.5 puts, expiration date October 1st, with expectations that the name will drop by over 11.5% by then. They paid about 22 cents apiece to enter this trade. All in all, spending about $200,000. What about the trade for the ticker FCX, Freeport McMoran, a name that I own in my portfolio, but it has been hammered as of late as copper prices go down. We have China shut down. This is impacting the prices of copper negatively. But somebody's betting on a rebound here by buying the 39 calls, expiration date October 15th. With expectations that the name will rise by over 12% by then. They paid about $1 a piece to enter this trade, all in all, bringing the total to about $1 million. What about the trade for the ticker COTY? This is for Cody, another name that I own in my portfolio. Not performing as good as FCX, but somebody's betting for a massive pop to come. They're buying the $9 calls, expiration date August 27th, with expectations that the name will pop by over 14% higher by then. They paid about 11 cents apiece to enter this trade, all in all, spending about $100,000. What about the trade for the ticker GDS? This is for GDS Holdings. They're making a bearish bet here by buying the 45 puts, expiration date September 17th, with expectations that the name will drop by over 15% by then. They paid about $2.50 apiece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker TSLA, Tesla? They bought the 750 calls, expiration date September 3rd. This is AI Day Optimism, by the way, with expectations that the name will rebound by over 13% by then. They paid about $4 a piece to enter this trade. All in all, spending about $2.8 million for this trade. What about the trade for the ticker KRE for regional banks? KRE tracks the 10-year yield, so it is a proxy for the 10-year yield. Not a 100% correlation, but it is influenced by yields. They're making a bearish bet here, so perhaps they're expecting yields to go down by buying the $60 puts, expiration date September 24th, with expectations that the KRE will drop by over 7% by then. They paid about 90 cents a piece to enter this trade. All in all, spending about $650,000. At the bottom of the table, what about the ticker TGT for Target? And this is a short-term one because it expires this upcoming Friday. They bought the 235 puts with expectations that the name will drop by over 8% by then. They paid about 75 cents a piece to enter this trade, bringing the total to about $375,000. Continuing with interesting trades, we got a lot of tickers for you here, folks. Tickers, tickers, tickers. How about the ticker SIG for Signet Jewelry? This is a spread trade. They're buying the 70 calls and they sold the 80 calls with the expiration date of September 17th. They paid about $1.7 million for the 70 calls and they collected in premium, about $750,000 from opening the 80 calls leg. All in all, the total entry cost for this trade is about $1 million. What about the trade for the ticker CROX? By the way, one of you asked me about this name. I can't remember the name of the viewer, but you know who you are. Looking at the chart, a monthly chart, this is a cartoon chart, a meme chart. Yes, we know we're all secretly, by the way, wearing Crocs, and therefore the stock blasted higher. But perhaps it is time for a pullback, because this is a cartoonish chart. You're not going to buy it at these levels. But somebody is, or perhaps somebody who holds the stock selling calls, pay attention here, because for this trade, they opened the 150 calls expiration date September 17th, with expectations that the name will rally by over 8% by then. They paid about $3.25 a piece to enter this trade. All in all, spending about $1.5 million. Lastly, what about the trade for the ticker VIAC, Viacom? They're making a bullish bet here by buying the 45 calls expiration date October 15th, with expectations that the name will rise by over 15% by then. They paid about 80 cents a piece to enter this trade. All in all, spending about $300,000. Moving on to the heat map analysis. Anything to see here? Nothing at all. No theme whatsoever. We saw a massive rebound off the bottom in the trading range today for the SPY and the Qs. Yet the only performer in the market today was the healthcare sector, led by Pfizer. But all in all, whether we're talking about biotech or drug manufacturers, even health insurers, all managed to outperform today. If you want to play this one, stick to the XLV. That way you're not tied to independent news for a certain company. If you buy Pfizer, for example, and we have some bad news for Pfizer, it will go down, you'll lose money. On the other hand, if you have the XLV, you have diversified your exposure in the healthcare sector, and therefore you're not dependent on one name, the performance of one stock. These stocks can move up and down big. FDA approvals, FDA denials. So the way to play the healthcare sector, in my book, is via ETFs. Another notable outperformer today was the stock of Kroger. And we heard from Warren Buffett, by the way, adding to his position of Kroger. The Wall Street analysts, the dummies that they are, they hate this name. But Buffett and I, we like the name. We like the stock. We got diamond hands, me and Buffett. Would you like to be with us? Or not. Kroger is my biggest position, by the way, and I talked about it last year. I described Kroger stock as the quote-unquote safest stock in the market. And by the way, here is the PE ratio map for the market. Any value here, by the way? Can you spot any value? Would you like to invest in financials when we have uncertainty in yields? Would you like to buy Verizon? How about Intel? Folks, there is nothing to buy here. Nothing. We're tapped out and there is nothing to buy. And therefore, I told you in a tweet today, I am significantly reducing my exposure and raising cash as much as I can. I have reduced certain positions by 70% or more because this market is getting toppy. Even 6 months ago or 3 months ago, I was still able to find some value in the market. Not today. It's over. There's nothing to buy here. And with that, we're moving on to the charts, starting with the 30 minutes chart of the SPY. We had a gap down in the morning, violating the support of 443. Now, I issued this tweet saying that the critical level to keep is 441, and the SPY succeeded in bouncing from 441. A massive bounce, closing pretty much at the highs of the day. So we'll call this V-shaped recovery number 3, with a footnote that perhaps a lot of funny business was behind it, and therefore the sustainability of this V-shaped recovery is in question. Here's another illustration for the same chart, by the way, a line chart. We had the consolidation range. We broke above the consolidation range. Today, we went back to the consolidation range, a short visit, and then rebounding higher again. On face value, is the behavior in the last few hours of trading bullish or bearish? The answer is bullish. You went back to the consolidation range, keeping the support of 441, rebounding from that level. Oh, and by the way, closing above 443. And when we zoom in to the 5 minutes chart, let's go over a day trade that I had The breakage of 443 as support was the trigger for the short trade, buying puts. We went all the way to 441. That was my target to begin with. It rebounded once, it rebounded twice, and we had the semi-double bottom formation. That was your covering signal. After that, the chart started to make a series of higher lows. So if you missed the double bottom, perhaps you got it and you covered at the third rebound, but your gains would have been diminished by then. Now, when you look at the big picture, this is a bearish formation, not a bullish one. The last few hours were bullish, but the big picture is turning bearish. What do I mean by that? Here's a daily chart for the continuous contract with SPY. We have a big red candle here with elevated volume. In addition, it appears to be that we're going back to the negative divergence in the RSI and the MACD indicators. Of course, the confirmation for the reversal will be violating 4,384.5. But I have an even better threshold for you to watch overnight. Perhaps by the time this video is already out, you will see a development in this chart. This is the 1 hour chart for the continuous contract for the SPY. We have a trend line that acted as a magnet. Yes, we have divergences breaking below that line, but quickly pulling back as if the line acting as a source of gravity, pulling the chart to trade within the line. The same gravity pulled the chart all the way, but it appears to be that we have a failure of reclimbing the trend line, and the threshold will be breaking the support of 4,432.25. If that happens, then we have a confirmation that this chart has broken the trend line, and this will be a leading indicator that the SPY futures chart will indeed break the support of 4,384.5 for sure. Moving on to the Q's 30 minutes chart. We're using a line chart here because we've been trading within a channel, a positive bullish channel, but the Q's is struggling to climb back to that channel. We have a double failure here, and the channel is moving far away from the chart right now. What I'm watching for is we have a descending slope of support from which the chart managed to rebound twice. If the chart fails to rebound again a third time from the descending slope line of support, which will coincide, by the way, with the support level of 363, then we're going to have a confirmation of the flush down. Speaking of, here is a daily chart for the continuous contract on the Nasdaq. From the get-go, this chart was a lot weaker than the SPY. We had negative divergences in the MACD and RSI indicators. The chart has been struggling to break above the consolidation range, and the only positive note for the chart was the candlestick pattern, which is a bullish consolidation, which will result in a pop higher. But now we have a down day with elevated volume, and the momentum indicators are weakening significantly, which is paving the way for the flush down scenario. So this is a dangerous chart right here. There are factors, specifically out of the FOMC minutes coming out tomorrow, that could rescue this chart, pushing the Nasdaq higher. But every other indicator out there is pointing out that this chart will start to flush down imminently. So watch out here. Perhaps the leading indicator for the SPY and the Nasdaq is the IWM, the Russell 2000, which already broke in the support of 218 today. The flush down is already happening in the Russell, and we're eyeing the support of 212 now. The resistance remains at 218, but this is significant weakness for the IWM. Absent of a rebound in the reopening names, the IWM will struggle to move higher. What do we have going on these days? Delta, we have warnings from Southwest and other companies already indicating that Delta is impacting travel plans, spending, etc. So perhaps we haven't seen the bottom yet in hotels, casinos, cruises, airlines, and we haven't seen the bottom in the IWM yet. Perhaps we want to wait all the way to 212 and see what happens there. But for now, we're moving on to the Dixie, the dollar index. Massive pop higher today. We talked about the weakness in Kiwis, but this was not the only reason for the Dixie to move higher. We have tapering, more indicators pointing out that tapering will be announced in the Jackson Hole meeting. In addition, we have a rush to safety, whether it is from the Asian markets, there is a sell-off, European markets, there is a sell-off, and now the US market's also having a sell-off. Therefore, we have a massive stampede to the safety of the US dollar, raising cash. The Dixie closed above 93, which means that it will continue to pop higher absent of a surprise in the FOMC minutes. If Powell says we're going to delay tapering due to Delta uncertainty or the consumer sentiment, I doubt it, but if he does, if you kick the can down the road, then the Dixie will pull back tomorrow. But if Powell comes out confirming the tapering announcement, then the Dixie will pop higher significantly. And a higher US dollar is not good for stocks, by the way. It is also not good for gold. Gold has been rebounding, but perhaps it will push the brakes here if the Dixie continues to move higher. Tomorrow is a critical day, by the way, for both the Dixie, gold, and commodities in general. Again, all we need is a confirmation from Powell that tapering will happen in September. Dixie pops higher, gold will go down. How far? We have the Fibonacci support level, which is around $1,750. If that doesn't hold, then we're going to have a problem. But for now, this is the level I'm eyeing. Of course, in the inverse scenario, if the Dixie fails, flushes down, then we will see a pop higher in gold all the way to about 1840. I doubt it. I think gold will go down, but we'll see. What about yields? What's going on here? For the 10-year, struggling to break above 1.28%. The behavior is a little peculiar here in the last few days, going back and forth within the trading range. No confirmation at all. It is not flushing down. We're talking about yields here. Not flushing down, but not popping higher either. Yields are waiting for the FOMC minutes. In my opinion, a confirmation of tapering will pop yields higher, above 1.28%, and perhaps above the descending slope line of resistance. There is another way to look at it, by the way. The bond market mystery that an announcement of tapering will actually slow down growth in the economy and therefore yields go down. So watch out for that scenario. And if that is the case, then the TLT will pop higher. This is a chart, a weekly chart for the TLT. Still trading within range, hugging 149, the important number. We're awaiting a breakout one way or the other, up or down. It will be explosive, and it could happen as soon as tomorrow. What about the VIX 4 hours chart? Look at the MACD indicator, by the way. Every single time the MACD crossed, creating positive impressions on the histogram, every single instance, the VIX popped higher by double digits. It looks that we have a massive pop ongoing here. The MACD indicator is not finished popping higher. Looking at the VIX alone, the likelihood is we will see another pop higher, all the way for the third and final attempt at breaking 20 once and for all, and closing above 20 for the week. For now, it looks like the pop is not over in the VIX, which means we will see weakness in the SPY, at least in the morning. Could Powell rescue the SPY? This is the $1 million question. What about Apple? What's going on here? 30 minutes chart, breaking above the resistance line of 150, but again moving solely based on options activities. For now, the chart remains bullish, trading above 150, but I am always skeptical about gamma squeeze rallies. They're unsustainable, and the reason is traders have a short-term scope. They buy call options, they make a quick buck, and they dump them right away. So these pops are pumps and dumps, unless we see sustainability in the move higher, meaning institutional and retail buying of the stock, not the options. I doubt that Apple will continue to trade higher at these levels, but for now, from a technical perspective alone, the chart is bullish, trading above 150. The likelihood is it will continue to trade above 150, at least from a technical perspective alone. Tesla, the souffle, what's going on here? A massive meltdown, a collapse. The chart went down to the support of 679. Forming a bear flag pattern. Today it is gapping down along with the market, but it managed to rebound higher along with the market. Surprise, surprise. Do you buy the chart here? Do you short it? The answer is if you already shorted the chart, you want to watch 650, to be specific, 657. If the stock goes down to that level again and it rebounds higher, then this is a signal that we have a solid bottom here, and the chart will go ahead and attempt to break above 679 once again. But if the chart violates 657 as support, then the next destination will be 629, and then you have a short trade, buying puts with a target of 629. But keep in mind that these premiums are increasing in value as we speak. Tesla options premiums were cheap last week because the implied volatility was down. And I told you this was an opportunity to buy options for Tesla, up or down, calls or puts. Now that the stock is moving rapidly, the implied volatility is moving higher, and those premiums are surging in value. What about BTC? What's going on here? Tulips. Again, don't be greedy. If you made a lot of money from this leg higher, take some profits because the momentum indicators are weakening. We have a saucer topping formation on the RSI. We have a negative crossing in the MACD indicator. Again, it's not the end of the world here. Perhaps BTC will go down to 42,000, test that level, and then rebound higher again. But why be greedy when you can sell at 44,000, for example? AMC, what's going on here? Moving higher today. Surprise, surprise, defying the negative action and the volatility in the market. I told you that will happen yesterday. I told you that AMC, meme stocks, will be sort of a hedge against volatility in the market in general. Why? Who knows? I don't know for certain, but it has been a pattern. It has been a reliable pattern. Every time we see a sell-off in the market, the NASDAQ, the SPY, meme stocks surge higher. And by the way, one of you asked me in the comments yesterday, and forgive me, I don't have the full question. I intend to answer it in full in a different video. But part of the question was regarding AMC, asking me if I'm buying AMC because I'm bullish on the name or perhaps the reopening. No. This is garbage. This chart is garbage. AMC is garbage. It's a bankrupt company. It shouldn't be trading anywhere it is trading right now. It should be trading at $5 max. But it is a retail story. It is a meme stock story. And for now, it is holding these levels. I bought shares of AMC as a hedge for the volatility this week. So this is a trade. I got in Monday. I will probably be out on Friday. In the meantime, I am selling upside calls to raise cash, by the way. So this is a short-term trade. It is not a reflection about my sentiment regarding the stock. This stock has no fundamentals at all. But again, it has been a pattern, a reliable one, that when we have volatility in the market, meme stocks move higher. So this is just a trade, a short-term trade betting on volatility in the market, while meme stocks act as a hedge against this volatility. Again, why? What is the reason behind that? I don't know. It is just a pattern that I'm following. And I am eyeing 41 as the maximum destination for closing this trade and taking profits. And of course, the entry point is 32. So if the stock goes below 32 or at 32, I will get out and I will cash in the call options that I sold. It's a strategy for this week alone. Anyhow, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have housing starts. Will this confirm the home builders sentiment that we got today? We'll see. And then we have James Bullard of the St. Louis Fed speaking. And we know that Bullard will smoke some hash and say stuff that he is not supposed to say. He's going to perhaps say we should raise interest rates by the end of the year. Something crazy, which will shake the market, by the way. But perhaps the market will not pay attention to Bullard because he is not a voting member, and we have the FOMC minutes. So all eyes on the FOMC minutes. What are they saying about tapering? We know we have Jackson Hole, and the assumption all along was that tapering will happen, the announcement that is, in Jackson Hole. But as I said yesterday, perhaps we already got the advance warning, because if the announcement happens in Jackson Hole in September, the market will crash right away because remember this, Powell said we're not going to taper MBS purchases separately from bonds. We're going to taper together. So when the announcement actually happens, the likelihood is it will be too late to exit. So was yesterday the warning? I told you Steve Leisman was at least 4 to 5 times in CNBC coming out with the breaking news banner, reading the same statement over and over and over again. You think that is a coincidence? Of course not. It is done by design. Hint, hint, we're gonna taper. We're gonna announce the tapering. If you wait until then, it will be too late. Are we about to get another, perhaps a clearer, advanced warning from the FOMC minutes? We'll see. This is what I'm watching for. Anyhow, folks, thank you for sticking with me all along this video. Thank you for listening. Thank you for watching. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.